session. We are reviewing basically the last semester's exam. How was this paper? Financial Management, August 2024 paper. Of course, it goes without saying. This is the paper that nationally we got the very worst performance. The very worst performance. It was a paper that was not your ordinary paper. All right. But if you have realized the trend your examiner is taking is the ACCA trend. So it means that this time round as well, if you would want to really survive, we shall be able to tackle, of course, your KASNEB questions and as many questions in this case here from the prestigious ACCA. ACCA stands for Association of Chartered Certified Accountants, right? Of course, it's a body which falls under what here? And the global accountancy framework, where of course we get ourselves also there as ISPAC, all right? Or as KASNEB. So in this case here, we will be borrowing materials from each other once in a while. So for us to overcome number one, as we do revisions, we shall be able to give you some, of course, KASNEB past papers and the ACCA manuals. Ladies and gentlemen, without, in this case here, wasting time, I would want us straight away to go to question number 1 of August 2024. So we have here August 2024 FM paper, question number 1. And in this particular case, they gave us a question on the average accounting what year returns. Average accounting returns. Now I can see we have 50 something, which is very, very good, very interesting. So I'll come back to part A. But first of all, allow us to look at part C, question 1, part C, the computational part, and then we go back to part what here? To part C. We go back to part C. So we go back to part A and B, I mean. Now, ladies and gentlemen, in part C, what are they telling us here? Part C, they are telling us that Zamole Limited is considering a project which requires an initial investment of shillings 156 million in machinery. So the initial investment there is 156 million that we have to put in machinery. The machinery will last for 4 years, after which it will have a scrap value of 26 million. The additional investment in working capital will be 19.5 million. The expected annual profit before depreciation are as follows. So you can see the year 1, 2, all the way to 4. Then we have here the profit before depreciation and what year? Tax. The company requires a minimum accounting rate of return of 15% from the project of this type. So required, determine the accounting rate of return and advise whether the project should be done what year should be undertaken. So then, ladies and gentlemen, what shall we do in this kind of a question? So this is a straightforward question, really. It doesn't need you to know quite a lot. We know that the average accounting return will be the average accounting profits, all over what year? Average investment. All over average investment. This is how we get our average accounting return. The average accounting return, we take the average accounting profits, preferably which profits are this net income. So preferably the profit after what year? The profit after tax. All right. So here they have given me profit before depreciation. So the very first thing that a good student did, first of all, was to give us the depreciation per annum. So depreciation per annum, for us to be able to offset this out of the profits before depreciation provided. So profit, or rather depreciation per annum, this will be your straight line depreciation. How do we get this straight line depreciation? We normally take the initial cost minus what here? Initial cost minus any scrap value. Any scrap value. We divide this by number of what year? Number of years. We divide this by number of years. So for us to be able to get this depreciation per annum, what are we doing? We are taking initial cost minus the scrap value all over number of years of this particular asset. I'll do my figures in thousands. My figures here will be in thousands. So we start with the initial cost. So initial cost, ladies and gentlemen, what do we have here? Initial cost. If I share back the paper, so you can see, ladies and gentlemen, here that the initial investment of the machine is 156,000 and the scrap value is 26,000. So 156,000. So we have here initial cost of the machine is 156,000 minus the scrap value, which is 26,000 like that. The number of years, they told us that this particular asset is a 4-year asset. So then are you able to give me the depreciation per annum? Are you able to give me the depreciation per annum here? Yeah, according to Tunde, is getting 32,500. Every year, this asset is losing 32,500. Is there someone else who can confirm that this figure is correct? Always like us working together, 32,500. So this gives us 32,500. This gives us 32,500. Now, ladies and gentlemen, this was the first thing that you ought to have done. This is the first thing that you ought to have done. And then, of course, now here, we can do our PBDT adjustments. They have given us here profit before depreciation here. All right. So for each of the years, 1, 2, 3, 4. All right. Profit before depreciations. I hope you are able to see this. They have given us profit before depreciation. What are they giving us, ladies and gentlemen, here? They're giving us, these are the expected annual profits before depreciation. 58,500, 58,500, another year 58,500, and then we have, ladies and gentlemen, 52,000. So we have here 52,000, and then lastly we have 32,500. So remember, ladies and gentlemen, from the formula, they want us to give them. This one here. To get average accounting returns, we are taking the average accounting profit, which is the profit after tax. So how do we get this profit after tax? Of course, we need, first of all, to knock out depreciation out of this. All right. So in this case here, come and they give us here the profit before tax. So basically here, you will take the profit before depreciation and of course this tax. Profit before depreciation and tax. You take away, you subtract depreciation. All right. So like you come and take each of these years, remember that is per year. You take away 32,500. You take away 32,500. You take away each year. Remember, this is straight line, and a straight line, we expect depreciation to be the same throughout. So is there somebody who can easily give us these figures? Now, which is profit adjusted for what year? For depreciation. Profit adjusted for depreciation. Is there somebody who is able to give us these figures? Remember, they gave us profit before depreciation. They never mentioned the tax anywhere there. So basically, I will be able to just subtract what your depreciation and get our normal accounting what your profits. Get our normal accounting profits. So this is what I shall use as my accounting profit for each year, because there is not even there a rate of what your taxation. So you guys have got so many questions to do and there's so many pieces of advice to take. You must be as fast as your teacher here today. You must give me numbers here. So we are getting, ladies and gentlemen, we are getting here 26,000. The first one is 26,000. Second one as well is 26,000. And then we have 19,500. 19,500, and then we have what there? We have a 0, and then we have a 0. Can somebody confirm these figures? Catherine has confirmed them. Are they okay? If they're okay, please put your thumbs up like this, like a ninja, a CPA FM ninja, CPA FM ninja, CPA FM ninja. So these are our now normal accounting profits. If we had tax, we would have adjusted tax to get PAT, but the rate of tax here was not provided. So this is what we shall use as our accounting profits. This is what we shall use as our accounting profits. So these are our accounting profits here. So these are our accounting profits. So once you give me these accounting profits, remember in the numerator, I need to average them. So give me the average accounting profit. Give me the average accounting profit, which will be 26,000 plus 26,000 plus in this case here 19,500 plus in this case here 0 divided by what here? Divided by 4. We divide this by 4 years. So many students were able to reach here, but they thought that 0 cannot be accounted for, cannot be. So they were taking this plus this plus this divided by 3, which was wrong, So then this gives us 17. This gives us 17. This gives us 17, 875. 875. 875. So up to here, my good students, are we really together? Up to here, are we together? Up to here, are we together? Yeah, we've been able to average to get the normal mean. Now, from there, and gentlemen, a good student went ahead here and they gave us the average investment. The average investment. A good student went ahead and gave us the average investment. And how do we get this average investment? This is very easy. You take the investment at the beginning. Investment at the beginning. Investment at the beginning. Plus the scrap value. Plus the scrap value. And then we'll come and divide this by what year? You'll come and divide this by number of what year? You'll come and divide this by number of what year? You'll come and divide this by number of years. You'll come and divide this by number of years. You'll come and divide this by number of years. So you take investment at the beginning plus our scrap value. Plus our scrap value. You divide this by number of years. Then how do we get our investment at the beginning? To get our investment at the beginning, we shall take the cost of the machine. Cost of the machine, we shall take cost of the machine plus any working capital provided. Cost of the machine plus any working capital. Cost of the machine plus any working capital given. Investment at the beginning. You take the cost of the machine. So cost of the machine, in this case here, it is 156,000. 156,000 is the cost of the machine. Have they given us, in this case here, any investment in this working capital? Investment in the working capital. Have they given us any investment in the working capital? So you can see here, the additional investment in working capital is 19,500. It's 19,500. So in this case, it will be 156,000 plus 19,500 plus 19,500. 19,500. And ladies and gentlemen, so many of you were depreciating this working capital. Working capital can never be part of our depreciation equation. Nowhere. So in this case here, most of you, when we were getting that depreciation, you are taking like this plus this. No. It's only this plus, or rather this minus the scrap value. But when you are looking at the total investment at the beginning, you look at like how much are we giving to get this machine? 156,000. This machine will not be able to operate itself. We need, in this case here, we need some working capital. So plus 26,000, like, or rather plus 19,500. So is there somebody who can give me this amount? Is there somebody who can give me this amount, ladies and gentlemen? So this gives us 175. This gives us 175, 175, 500, like that. 175, 500, like that. 175, 500 like that. And then now you'll be able to come, ladies and gentlemen, here and they give us our average investment. So go ahead and give us our average investment. Go ahead and give us our average investment. So if you do this 175,500, we add the scrap value. Scrap value, I hope you're able to remember 26,000. We divide by 2. We divide by 2. So we'll take 175,500 plus that scrap value. We can check it out here. This scrap value. Okay, remember the scrap value here. Our figures are in thousands, remember. 26,000. 26,000. And then we shall be able to, whatever we get there, we divide by 2. So are you able to give me this answer, ladies and gentlemen, pretty fast? Yeah, according to Catherine, we are getting 100, 750. 100, 750, like that. So that is the average investment. That is the average investment. And don't forget, what you are calculating, ladies and gentlemen, is known as the average accounting return. Average accounting return. The average accounting return. The average accounting return. So the average accounting return equals average accounting profits, average accounting profits over average investment, over average investment. So the average accounting profits, you guys have given me a value up there. Do you remember the average accounting profit? You guys had averaged something there. You guys had averaged something there. You guys had averaged something there, which somebody should be able to remind Mwalimu here pretty first. Which somebody should be able to remind Mwalimu here pretty fast. Somebody should be able to remind Mwalimu here pretty fast. 17,875, isn't it? So we have here 17,875, 17,875, all over the average investment. And what is our average investment? 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 It is 100, 700, what here? 50. Whatever we get, we multiply this with what here? With 100. Whatever we get, we multiply this with 100. Whatever we get, we multiply this with 100. So what figure are we getting there? What figure are we getting there? What figures are we getting there? What here? 17.74. So they're getting here 17.74%. 17.74%. 17.74%. 17.74%. So they're getting. How are the marks awarded? I'll be able to show you. I have access to these things. So, and then I'll be able to show you another method. I'll be able to show you another method of doing this. Another method of doing this. So you can see, ladies and gentlemen. You can see, ladies and gentlemen. You can see, ladies and gentlemen, another way of doing this. All right. So, ladies and gentlemen, that is really, really very, very important for you to know this. And then, of course, come and compare this with the required. Are you able to see the required minimum? Are you able to see the required minimum? Are you able to see the required minimum? The required minimum. The required minimum. So the required minimum accounting rate of return is 15%. And our project is giving us a whole what here? 17.74. So this is more than 15%. And therefore we should accept what here? And therefore we should accept the project. Therefore, we should accept the project. Therefore, we should accept the project. Therefore, we should accept the project. Now, other students who went ahead and did it this way, especially on this average accounting return. On this average accounting return, you always get books, SEC books all over. I mean, not being very clear on how this average investment is computed whenever we have a working capital. Yeah, so average investment. So, ladies and gentlemen, remember, how do we get this average investment? We look at the initial. We look at the initial investment, plus, in this case here, what we shall get, plus what we call the terminal cash flows. The terminal cash flows, and then you divide this by what year? You divide this by 2. You divide this by 2. You divide this by 2. So then our initial investment, please listen, our initial investment, in this case here will be that 156,000 plus the working capital of 19,500 plus the working capital of 19,500. Can somebody in this case here give me this figure? Can somebody give me this figure? 156,000 plus 19,500. So 156,000 plus 19,500. Remember, 19,500 is our working capital, which was invested at the very beginning. So they're giving me 175,500. 175,500. They're giving me 175,500. Then come and give us this terminal cash flow. Give us the terminal cash flow. Give us the terminal cash flow. So terminal cash flow, of course, the scrap value. We shall be able to realize our scrap value. We shall be able to realize our scrap value. At the end of the project, we shall realize our scrap value. But now these other scholars will come and tell us when we are getting this average investment, that this particular working capital will be released to us. So in that case here, for their case, they'll come and add 19,500. Yeah. So then can you kindly give me 26,000 plus 19,500? 26,000 plus 19,500. What do we have here, ladies and gentlemen? So remember, you're getting this particular free of charge class from RCM College. RCM College, my name is Dr. Joshua Aura. If you would want to reach out to us for this AFM, Product for Financial Management, please don't hesitate calling us. Our number is 0793 555 000. 0793 555 000. I'm so sure most of you are used to this other number. It is still ours. It is still ours. 0719 525 1,000, like that. You need to call us. All right. So then we have here 45,500. 45,500, like that. And therefore, the average investment would be our initial investment of 175,500 plus, in this case here, this 45,500. 45,500, you divide by what year? You divide by 2. You divide by 2. You divide by 2. You divide by 2. So is there somebody who can give me this average investment? So you will not get the same answers, but either way will be right. Because remember, finance is something that is really evolving. So there are so many, disputes. Disputes at times, in this case, scholars are disagreeing. Either way, these two methods, they make sense. Of course, you'll not be able to get the same answer, but either way, you'll be correct. So in this case here, we have here 110,500. And then, of course, if you're using this approach, then our accounting average return will be that average accounting profit, which I've forgotten. Somebody, was it 17,750? All over 110,500. All over 110,500. All over 110,500. This average accounting profit here, I've forgotten it. The average accounting profit, I've forgotten it. Is there somebody who can remind me this figure? The one we got up to the one that we took the profits for each year and then we added. So you're able to remind me what this is supposed to be, 17,800. 875. It's making 875. So this one, in this case, if we take this divided by this, what are we getting? This is now what gave you 16 point what here. This is what gave our students here 16 point something. And either way, if you look at the given marking scheme, if you look at the final, not the one that I have there, if you look at the final marking scheme, either way they were giving full marks. They were giving full marks. So again, this is more than what year? This is more than 15%, and therefore the project is what year? The project is viable. The project is viable. The project is viable. So we don't want to look at the past, like, I mean, you failed, you did what? No, the question is, should they give us this kind of a question in the future? Are you at a position of now getting this AAR correctly? In the future, should they give us this kind of a question in the future? Shall you be able to get now full marks? Shall you be able to get full marks? That is the most important thing, ladies and gentlemen. That is the most important thing moving forward now. Shall we be able to get all the marks under accounting, average accounting, rate of return, waiting to get feedback from you? It's only 2 students. That means I'm a very lousy, bad teacher. I'm a very bad teacher. Students are not able to understand more. Thank you so much. So we should be able to appreciate this. We should be able to appreciate this. Ladies and gentlemen, moving forward, you know, most of you, especially the students who tried this paper, if you tried this paper and then you failed, it will not be wise for you to just join what year? The normal class. When you join the normal class, what would it mean? Again, you start taking notes. If I were you, I would buy into this idea that Dr. Joshua is telling you, that let's form a special revision class. A special revision class where simply we'll be tackling questions and answers. Yeah, where we'll be simply tackling questions and answers because already you have the notes, right? So by the time they're giving us this exam, our knowledge level will be up there, So on this special revision class, ladies and gentlemen, we are going to charge Kenya shillings 3,800. Kenya shillings 3,800, which is a discount, you know, because our normal classes are 4,800. 4,800. So we simply form a special revision class where our work will be to tackle questions and answers topically. And we should be able to finish those questions and answers topically in a very, very short time. In a very, very short time. Does this sound like a good plan, somebody? Does this sound like a good plan? Or would you guys want to join? Yeah, it does. I'm telling you, this is what will work for you. Because if you look at the financial management examiner, is raising the bar every other day. So the very best thing is for us to form a special class where we tackle the KASNEB questions, we tackle the ACCA questions. I mean, we do exams. And then, of course, I give you access. You see, again, the moment you pay for this special revision class, we shall also be able to put you together with the other students. With the other normal students. So should you get time for the normal class, if you want the normal class as well, then you'll be able to attend those classes if you wish. But I'm telling you what can, in this case here, assist you guys is this special what year? Is this special class, So we shall charge you Kenya shillings 3,800. I can see somebody in this case they're complaining that the economy is not doing very well for them. But we shall overcome. That's why we have been able to also accept like a discount, 1,000 bob discount. And again, remember, you don't have to pay the whole amount at once. You can pay 1,900 today, and then you pay the balance end of the month, or even next month, all right? Of course, we are teaching you finance, and all of us, we make plans. So our pay bill, very, very important. Our pay bill is 6242. 839 account. You simply write FM SPR for the system to pick you very well. FM special revision. So you'll only pay if you pay. But remember again, if you have not done this paper before, you have to join the normal class. Because you won't fit here. If you have not done this paper before, you have to join the normal class, because we also don't want problems of somebody will be telling us, how do you discount? How do you do this and this? Of course, I will really be moving at a slow speed, great speed. All of you will be able to appreciate. But again, if you have never attended the paper before, your special class is the normal one. You go to the normal class, work hard from there. But if in this case here you have ever attempted this paper before, then join the SPR class alone. But again, we have said as an additional thing, from this SPR, we shall be able to add you to the normal class. We should be able to add you to the normal class. Yeah. And this SPR should be over the weekend only, weekends only. So we shall agree whether it is Saturday and Sunday, either Saturday double, or one lesson on Saturday, the other lesson on what year on Sunday. Then that will be good. Shall be able to come up with a timetable. All right. So thank you very much. And then when you look at, you'll be able to access, you can't. I'm telling you, ladies and gentlemen, where this examiner has reached, what this examiner is doing to students, you can't pass these exams without using LMS. LMS for the very new students, stands for Learning Management System. It stands for the Learning Management System. So you should be able to get, once you pay whatever amount here, we should be able to give you access to the Learning Management System, where we store our videos. Like I've done so many videos, where we store our videos. And by the way, this is what I normally do, especially for the online students. What I normally do is to tell you that come next weekend, we shall be dealing with working capital. So in between the week, you special revision FM ninjas, go and watch all the videos of what you're working capital. You watch all the videos of working capital maybe there would be like 5 of them. So you watch them, finish watching them. And then now when you come on Saturday or Sunday, because I'm the chief ninja, remember, I'm the chief ninja, the coach. What I will always do is to come up with like a question. I tell you guys, attempt this question first. Within the KASNEB's time, the 30 minutes something time. So you attempt a little bit in whatever time, could be 30 minutes or whatever. At times I realize you guys, all of you are stuck. And then now if you're now in this case, you are developing great creative thinking systems for this paper. This paper needs creative thinkers. So we shall be having a forum where, because we are in a WhatsApp group with you, where we advise you that get to the LMS. Yeah, Walter Kiprop, I think I saw you. Yes, I'll be able to add you, Walter. Please will send me your number. I saw you. There was one student only one paid last weekend. This is my personal number, only for Walter. Walter, you can call me, or not call, but just text me. So I get your number, then I add you straight away to the special revision. And then I add you to the special revision. Now, ladies and gentlemen, Sunday may be tricky. We shall discuss about that, don't worry. Now, as I move away from this concept, ladies and gentlemen, I go back to part B and part C. There is something very important I would want to show you for students, in this case, who have not been at RCM. This is normally what we do. FM is not, financial management is not open, but I can just use this to demonstrate. So this is our learning management system. This is our learning management system. All right. This is our learning management system. Now, so this learning management system has videos in it. Most of you, our students really, they know how to use this LMS. So like you'll come and of course the teacher will tell you, watch video number 2, watch video number 3 before we meet. So for example, if you come and pick on a video, let's assume in this case here, somebody is watching this video number 3. It's 1 hour something. So you'll come and click there. Always ensure that you maximize your screen. All right. And then not unless you're busy.
So we have topics only there, very fast time. But this time around, we are looking at what we call a group of assets.
Come and give us here
assets that are able to generate independent cash flows.
And then I can
group of assets that are able to generate independent cash flows. We call them cash generating.
So straight away, you are able to save
cash generating unit.
Able to save
Cash generating unit. Also, we are generating a CGU.
So once you pay, we shall be able to do what here. We shall be able to ensure that you get access to really, you get access to the LMS, which has really been able to assist students at RCM. The students who are with us last semester, the students who have been with us last semester, what is your take with this LMS? Last semester from other levels like part 1, is there somebody who used this LMS very, very well? Anybody who is able to give us a testimony that this LMS is great, is a great tool? So if you're tempted and you paid normal class, do you pay again the 3,800? No. We shall be able to shift you. We shall also add you this special vision. Gideon, if you're tempted, LMS is a game changer. Thank you very much, RV. It is a real game. So this LMS, because you can increase the speed, and you're storing there great things like that. And then the other advantage of this LMS, when you watch those videos, ensure that you watch them until you reach 100%. Most of you never watched up to this level. When you watch these videos up to 100%, the LMS will be able to give you a certificate of attendance. That in this case here, you have attended, that this is James Kamau. James Kamau has attended financial management training for 3 months, a certificate automatically. So, you know, we are trying to give you things that can really motivate you. Certificate of what here? Attendance. And I'm telling you, those certificates here are game changers as well. Because you know, when KASNEB gives you like one certificate saying you are a accountant, many people may not be able to understand. But now, when you get certificates from RCM saying that, for example, you on the money, that's how you can easily choose. You choose the certificate that works for you. You don't have to put like all of them. No. You choose like a few of them, depending on what you're doing. All right. And you put them inside some good folder, plus your degrees, plus your other qualifications like that. People will be able to appreciate even that certificate of financial management more because it speaks volumes. It speaks volumes. All right. So then ensure that you clear. And the other thing, you'll get somebody in this case here, for example, in the LMS, they register their names like this, that they're registering like, instead of saying Kimani, hello, sorry, I disappeared. I hope we never lost anybody. Great. So shall you be able to write your names in full, because once that certificate comes, you shall not be able to change your name. You write your name the way it appears on your certificate. That is why we keep on telling you that, hey, and ensure that you are filling that Google Sheet document on your WhatsApp. Great. Thank you so much. So now we can go to part B and then part A. So part B, what is part B talking about as we finish? Because the other questions, I'll do them when you are my student. So as we finish, ladies and gentlemen, we are told here The principle that governs all ethical behavior for finance managers in practice and in business helps them to navigate the complexity of their work. In reference to the above statement, explain 3 fundamental principles of ethical behavior. We call them the ethical standards. The ethical standards. They cut across. These are the same standards that you normally study in audit and assurance, all over the ethical standards. Ethical standards. So the ethical standards, we have a whole standard on integrity. A whole standard on integrity. We have another standard on confidentiality. Confidentiality. We have another standard on objectivity. Objectivity. What we call independence. Independence. Then we have in this case here another standard called professional behavior. And then lastly, we have what we call professional competence, and due care, So these are 5. The examiner wanted you to do, to state only 3 and explain them. So under integrity, we are required here to be straightforward. We are required to be honest in all our dealings. Integrity, honest in all our dealings. Don't be that kind of a dubious accountant who likes, in this case, lying. No, finance manager, kind of managers would want even to, like, the examiner, or rather the boss of yours has told you to do a project appraisal. You will never be a people pleaser. I've gone to do an appraisal and I've gotten that this is negative. So even if, ladies and gentlemen, there is whatever, I'll be able to come and tell these guys, I've done this appraisal and this project is not going to be good for your company. It's not going to be viable. So in this case here, poor network. Sorry for that. How about now? Are we back? Poor network. Okay. Just give me a minute. Oh, okay. Are we back now? Are you able to hear Mwalimu? Not yet restored. Yeah, just give me 1 minute. I'll show you something. Just 1 minute. I'll show you something. 1 minute. I show you. Hello, ladies and gentlemen, are you able to hear Mwalimu now? Now it should be very okay because I've changed to a Starlink connection. We shall be running away from Safaricom like crazy.
Safaricom is a disaster. Yeah, now I've changed just rooms. Now you can see Starlink. Yeah, Starlink is very good. So even now the two studios that we had really thought that Safaricom would be also lucky. Now they are going to lose. Now it shall be Starlink. All right, ladies and gentlemen. Great. Great. So what do we have here, ladies and gentlemen? Then what we have here at the end of the day, now very nice and clear from Mombasa. Great. So then what we have at the end of the day, in terms of professional ethics, at least one person has paid, which is very good. So in terms of ethics, we've said number one, here I don't have a whiteboard. So we have here integrity. Under integrity, we are required here to be what? Here to be straightforward, to be what here? To be honest in all our dealings, to be honest in all our dealings. And then number two, we have confidentiality. Confidentiality, ladies and gentlemen, confidentiality, that's standard number two, that accountants or finance managers see what mdomo. If you are here, and of course, in this case here, whenever you hear that somebody, for example, comes to your office, somebody comes to your office, all right? And this person, in this case here, for example, wants an advance, salary advance. They want a salary advance. And then once, in this case here, you get that kind of communication, and then you go, you start discussing these people, this person out there, then you are not born to be an accountant. An accountant should be able to die with so many secrets. All right, not unless it is something that is pushing you, something in this case here that is of public interest. All right, yeah, you're right. That is of public interest, ladies and gentlemen. You shall not be a gossiper. Accountants are never gossipers. All right. So, for example, your company is going to post like very huge profits. So you get out of your company, you're the finance manager, you're privy to that information, you go and share that information with your wife at home. So then your wife, in this case here, goes and buys shares from your company, knowing that in 2 months' time, the company is going to post huge profits. And the moment they post these huge profits, what will happen is that the share price will go up. So if your wife does that and she profits out of that, that is known as insider trading. Insider trading can take you to jail. You as an accountant. That can take you to jail. You as an accountant. So in this case here, accountants are supposed to be men and women of few words. If you are here and you know that you are that person, unasema yani mimi nataka, Kiswahili mnasema namna gani, si umbea. Kuna Kiswahili jina watumia sana, moshene. Yeah. You ujue straight away, please change your course. Change your course before you start doing advanced. Yes, change your course before you start. Change your course before you start doing advanced. Now, from there, ladies and gentlemen, we have here objectivity. So objectivity is all about you being independent. So this is all about you being independent. Independent is all about you being independent. It's all about you being independent. Yeah. You see, for example, you could be a finance manager in Parliament, the Parliament of Kenya. And then you are being required, for example, to get outside there and do some evaluation. When you go to do some evaluations, there are so many people out there who have got various interests. There are people who would want to they will come and tell you that you go and overstate this value. So the moment you go their way, then you will not be objective. You will not be objective. There will be an international water disaster there. We need people who are objective. People will not be driven by small things here to lose their objectivity. Yeah, please go ahead and ask questions. Go ahead and ask questions. All right. So, you know, Kenyans, generally, we are very, very greedy. That's why I was reading the other day that about 60% of our people here, we go to our workplaces every morning with the intention of stealing. Those are not finance managers, because chances are you won't be independent. And then remember, to be independent, we normally use the acronym SURFACE. The acronym SURFACE. The acronym SURFACE. We normally use the acronym SURFACE. To be able to evaluate your independence, we normally use the acronym SURFACE. Yeah, thank you very much. The first one there is self-interest. We have advocacy, familiarity. Yeah. So self-interest, advocacy, familiarity. Continue like that. That's very good. We have intimidation, intimidation, intimidation. And then we have what we call self-review. We have what we call self-review, self-review. We have what we call self-review, self-review, self-review. Now, under self-interest, ensure whenever you are called upon to do like now evaluations, you as a finance manager, ensure that you are really impartial. If you have shares, for example, in a company that you've been told you to go and value, you know that those kind of shares will drive you to saying that the company has got a higher value. So you should be able to say no. All right. Yeah, there are threats in this case here to independence. There are threats to independence, yes. Threats to independence, surface like that. Intimidation, advocacy, very, very good. And then, ladies and gentlemen, lastly, not lastly, but second last, we have here what we call professional behavior, very, very common. A standard on professional behavior. A standard on professional behavior. So under professional behavior, what are we required to do, ladies and gentlemen? Under professional behavior, what we are required to do under professional behavior is that we shall never engage in activities that puts our body of accountants into disrepute. We shall not be misbehaving outside here. When you are a thief, then automatically people will say all accountants are bad. People will start being stereotypical against accountants. Which reminds me a case of one gentleman who was a member of ACCA. You know, I'm a member of ACCA. ACCAs were given that red tag to wear. Wherever we go, we have a red tag here. So this guy went and found people, of course, they were eating and drinking some things which were far away from the taste of water. And he had one menu for the road. And then unfortunately, the guy now went a few steps and he fell down. And it was during some very rainy season. So when this guy was down there, I mean, near a ditch, many bad things happening there. And then, of course, following day, the guy was unconscious there. He was caught by the cameras, sleeping there. And now he was on the local television channels. And what sold him is this ACCA badge the guy was wearing there. So this guy, unfortunately, now was struck off the register, of accountants. Being struck off a register of accountants is so bad, punitive, because you know now, if you're running an audit firm, you can't sign financial statements. You can't sign your opinion now. All right? Because it's only partners who are able to sign auditor's report. So when this guy was struck off the register, members felt very bad. Members felt very, very, very bad. They said that, I mean, this guy was just having his food. How is this related to his practice? That in this case, the professional body is high-handed. It has done something very bad. Do you think in this case, ladies and gentlemen, the body was wrong to strike off this guy from the register? Do you think this body was wrong? This guy was too drunk. He's outside there on a muddy area, unconscious, wearing in this case here the emblem of the professional body. Do you think in this case here the body was too too aggressive on him, or did he do the right thing? The boy only struck the head bunch, not the person. The body was doing the right. The body was doing the right thing. Yeah, yeah. Because even when you are imbibing, when you are taking, in this case here, I mean, you're not supposed to overdo those things. Because everywhere we are, we should be able to engage in things that are able to give our professional body respect. We must be modest, yes. Modest, yes. Nobody is saying that you don't drink. Nobody is saying that you don't drink, but if you're drinking honestly, don't drink that level where you become like a child, and then you start, in this case, you're abusing people, you are fighting. I mean, that one, when people look at you, they'll think all accountants behave like that. All accountants behave like that. So then we have the last one is professional competence, and due care. So remember, in terms of professional competence, yeah, you should have left the badge back home. Professional competence and due care, you can only be said to be competent by doing what you guys are doing exactly. You can only be said to be competent if you are learning all through. If you are learning all through. So remember, IFRS says International Financial Reporting Standards, tax rules, they're changing every other time. So if you're not learning all through, then automatically you will not be competent. And then, of course, we have the concept of what you do care. We can only say that you are caring for you are caring for your clients if you are competent enough, if you know those standards, etc. And then, ladies and gentlemen, part one of this question was quite a nice question. We have here venture capital and a private equity. Is there somebody who can give us the difference between venture capital and a private equity? Venture capital and a private equity. From the word venture. Before we look at this one, venture capital and private equity. Venture capital and private equity. Is there somebody who could be knowing the difference between venture capital and private equity? Again, one thing that I've realized, this paper needs you guys to be very well informed. So I'll be sharing articles with you from the Business Daily. Often, whenever I come across a good article, I'll be taking a photo of the same, make it a PDF, and share with you so they can read. Because like venture capital, I mean, this is really a big thing in Kenya. So to give you a very good example of this venture capital, like right now, you know, RCM, we are really growing. We are doing a primary school at Isinya. This will be a primary school doing the international curriculum at Isinya very soon, maybe 1 or 2 years. It's under construction. I mean, there are so many guys who are approaching us right now, who are telling us that let's put in some capital. And then, of course, that's not debt capital. It's venture. They are venturing into. It's venture capital. So once in this case they put in capital, in exchange for their capital, we shall give them, in this case here, what here? Shares. We shall give them shares. So under venture capital is a form of financing where capital is invested into a company at the startup, or when it is very small, in exchange of equity in the company. Yeah. And if you are keen enough, ladies and gentlemen, you must have gotten where, for example, let me give you just a local example that you'll be able to, in this case here, just understand very fast. As RCM, if, for example, we wanted to raise venture capital today, what will we do? We'll go to investment bankers like Dare and Blair. So these investment bankers, they should be able to look for those venture capitalists who like investing in primary schools, for example. Like, you know how, McKinney in this case here was, they gave out shares to some venture capitalists, McKinney School. Then we have private equity. So is there somebody who is able to tell me what private equity is? PE. You guys, you should be able to give me these definitions. You should be able to give me these definitions. Private equity. Yeah, Winnie, I'll be able to repeat. I'll be able to repeat. I may not have the same using the same words, but whenever we talk about venture capital, so under venture capital, the investor who is coming in will give us what we call startup capital. Will give us startup capital or a business growth capital. And then in exchange, we give them our shares. We give them our equity. We give them our equity. We give them our equity. So under venture capital, we'll get an investor from either our local area here or even international investors coming to give us startup capital, or what we call business growth capital, when they are very, very small. When they are very, very small. When they are very, very small. All right? All right? And then in exchange, we give them like 25%. We give them like the guy who has approached us at RCM. This guy is, we don't like him. We don't like him because he wants to get controlling interests. He wants to get, in this case here, more than 50%. And yet we have really struggled. Remember, it's something that we'll be able to show you guys very soon, because we want your children to come and study there. Yeah. Yeah. And then now somebody comes from nowhere because he has serious monies. He tells you that now, for me to come on board, I'm giving you this amount, but you have to give me this percent, which is more than 50%. So now, we would rather in this case here build slowly with loans, with what you guys are able to give you as fees, etc., like that. How about private equity? Somebody talk about private equity. Sarah is talking about private equity. Is a private capital which is not shared to the public. To the public. I like the name public there. Remember, private equity normally will be at the stock exchange. Will be at the stock exchange, private equity. At the stock, like Nairobi Stock Exchange. So Nairobi Stock Exchange, now they have got like what I would call two counters. So they have what we call private equity and the public equity. Public equity, whenever we have listed companies wanting money, listed companies, they will easily go and they sell their shares to the public. They sell their shares to the public. So the shares are advertised and the people are able to buy. Like, for example, when Safaricom was going publicly out there, they sought for a public equity. They did what we call an initial public offering, IPO, initial public offering. But again, ladies and gentlemen, there are some ninjas at the stock exchange there who know that companies are at the stock exchange to look for what? To look for funds. So then what these people will do, like now, if I was a rich man, and I really pray that I'll be very rich, to reach a level where I'm able to do a private placement. So I go to Nairobi Stock Exchange, tell Nairobi Stock Exchange, my name is Aura Joshua. And as Aura Joshua, I have some 10 billion Kenya shillings. I don't want to put this money in Equity Bank or in any other bank. I simply want to put this money in your way, on your way. So should we get, like, for example, Kenya Airways? At times you may not be having that good reputation to raise money publicly. But you see, you may easily get one or two individuals like Joshua Aura here who are, for example, billionaires, all right, who are willing to place their private funds with you, So that becomes a private equity. So basically, private equity, again, they're not run by one individual. It will be, in this case here, we have Sarah, for example, we have Winnie, we have another person. We form a pool of funds that we call private equity. And that private equity firm is known. Whenever these big firms want money and they don't want to get public, they don't want to sell their shares to the public, they may not even be having those shares to sell. All right. Then in this case, they shall look south and they come straight away to the private equity counter, private equity counter, private equity counter. So please listen here. Please listen here. So whenever we talk about private equity, it refers to ownership in entities that are not publicly listed, in exchange for equity or ownership stake. I'm reading here. To invest in a company, private equity investors raise pools of capital from limited partners to form a fund. And this fund is normally invested as capital into promising companies, mostly stagnant or distressed companies with the potential for growth. Listen, ladies and gentlemen, and listen to me very well. I don't like that definition, really, the one they've given me here. I would want to repeat here that whenever we talk about private equity, we are looking at a pool of funds from private investors, which is invested in organizations that do not want to go public. So it's invested in organizations that are, financially distressed, for example, right? Financially distressed. And of course, at the end of the day, we shall be getting what we call equity shares. So in that case, then the business should be very promising. Of course, currently it's financially distressed, but the business should be very, very promising. The business should be very, very promising. And then, ladies and gentlemen, there is one thing you need to be doing. Like Fanny is saying to pardon, you should be able to have Zoom make notes for you. Zoom should be able to make notes. This theory, the theories we're discussing here, Zoom should be able to give you very good notes. It has got this AI. If you go to your Zoom, let me see where it is. If you go to your Zoom here, it has an AI companion. AI, like now start meeting a summary with AI companion. Then we say start. Yeah, that one, yes, AI companion. So once you say AI companion, when I explain a little bit, it takes my explanation and it is able to give you an elaborate answer, a better answer. Then you need to clap for me a little bit for educating you on AI Zoom. Yeah, so you don't keep on writing. People don't. People don't write. Like when you are doing a paper like auditing and assurance, a paper like auditing, you don't have to write notes. You simply tell Mwalimu, explain. So Mwalimu explains, and then this thing does put up the notes for you. Yeah, thank you so much. It takes notes for you. So I explain again. A real ninja, yes. So I explain again. I'm saying that under private equity, we have firms that cannot get shares publicly because maybe their image is tainted. You see, when you're making losses, like for example, KQ today, if KQ today wanted to raise funds from Nairobi Stock Exchange, they will not be able to get funds from Nairobi Stock. Of course, this year they have started going to profits, but still not yet. People don't trust it. So then in that case here, what do? Like now they themselves, they went for three private equity entities. At first, they borrowed a loan from them. So we have here Equity Bank, Absa Bank, Standard Chartered Bank. They gave it what we call a syndicated loan. You'll be asked next time. They gave it what we call a syndicated loan. They gave it what we call a syndicated loan. Syndicated loan. They gave it what we call a syndicated loan. At first, it was a loan. So if it's a loan, it can't be a private equity. That's debt. That's leverage. But you see, at the end of the day, KQ was not able to pay. KQ was not able to pay back the loans. So they called, in this case here, these guys into a meeting and told them, I mean, we can't give you money, and not unless you want us to die, allow ourselves to give you what here, to give you equity. So they gave them what here? Shares. So this automatically now changed to what we call a private equity. Private equity. Oh, great, Sarah. Great. Thank you so much. We shall overcome. We shall overcome. We shall overcome. Now, it will come to your email. It will come to your email, Caro. If you don't get it, then I'll be able to send you the notes. Of course, myself, I'll be able to send the notes to you. I'll be able to send the notes to you. I'll be able to send the notes to you. Now, ladies and gentlemen, now that you have this AI companion on, I should be able to come here and just go through this pretty fast. Go through this pretty fast. The other question that they wanted, which is the last question for us today, they wanted us, ladies and gentlemen, to distinguish between business angel finance and the lease finance. I would start with lease finance. Anytime. Because lease finance, ladies and gentlemen, is really an easy thing. Lease finance. For example, as RCM, we have some little space at Stanbic Bank. You've leased some space there, all right? So you see, when you lease space, you are required here to take, like, say, a minimum of 5 years lease term. And automatically, if you have the money, you should be able to pay your entire lease at once. But you see, in most cases, we will not be able to get that kind of money. So then what normally happens, we enter into a contract of lease rentals. So under lease, we are now being financed because we can't afford to pay the whole thing. Under lease financing, ladies and gentlemen, we will have the owner of an asset. The owner of this asset is called the lessor. Lessor, all right? Who transfers possession or right to use the asset to another party. So we have the owner of the asset transferring the possession or right to use the asset to another party for an agreed period of time. In return for rental installments. So whenever we talk of lease financing, you must talk about the lessor. You must talk about the lessee. You must talk about, in this case here, this installment rental amount. So you're being given the right to use an asset for a period of time, which has to be agreed. In exchange, you shall be paying lease rental installments like that. You'll be able to get everything. How about this angelic investor? You guys must have heard about business angels. So business angels are normally high net worth individuals. Hawa ni masos, sijui kama ni sos masonko. Hawa ni masonko sasa. So nakuta huyu sonko anaitwa business angel. All right. He'll be able to provide some financial support for small businesses. This is a small business. For small businesses in exchange for equity in a company. A business angel. Kama Angel Gabriel, business angel. So they come, they find you like RCM, like 5-6 years ago, you were really struggling, but God is great. Yeah. So in this case here now, we are not. So those during our struggling times already we have here. So you get somebody coming like an angel, right? They could be seeing what you are doing on social media. So they simply come and they pump in money. Business angels, you give them equity, but because they are very, very rich, in most cases, they will run with you for some time, like say 5 years, 10 years. And then once they see they have recouped their money, they disappear. They disappear. And at times in this case, they leave you with lots of wealth. They may not even take back all their money. At times in this case, they are called blessers. All right. All right. Blessers. Blessers. Okay. So in this case, they simply come and bless your organization. They give you money. They'll be able to hold on to your company shares for some time. And why do they have to hold on to your company shares? Basically, it is for purpose of teaching you how to run a business. How to run a business. All right. So that's what we call a business angel. And I believe when Zoom will be able to give you the notes, I believe they'll be able to give you better notes than what I've given you. Great. Thank you very much. How will this angelic investor differ from venture capital? You know, venture capital is with us for the long term. Yeah, he'll hold, in this case, his shares forever. But an angelic investor, an angel, this angel, first of all, may not even tell you to do valuations. I'm telling you, venture capitalism, ladies and gentlemen, you need to do a lot of work. There will always be some middle parties there. There'll be agents there. There'll be agents there. Actually, Francis, I wanted to use that term, but I feared a little bit, but I like that term. How my sponsors, Mbabas. Yeah. So in this case, ladies and gentlemen, when it's an angel investor, the angel investor will come in, he'll give you so many goodies, like kind of freebies, some kind of freebies. All right. So many of them. All right. He'll take in on some shares, but it's not with you forever. These are those old wazers, for example, come like now from France. They come and buy into your business idea. They want to help you. And that is why we started by saying high net worth investors. They're not really interested in your company. They may not even be able to be part and parcel of your management in your company. So they basically want to help you. I hope I've answered your question. So ladies and gentlemen, I'm looking forward to getting you guys signing up for this particular Adani. Is Adani really an angelic investor, or is he an opportunist? Is he an angelic investor, or is he an opportunist? Yeah, somebody may argue that it's an angelic investor because they stay with us for 30 years. For 30 years, and then he'll be able to go back. We shall overcome. We shall overcome. We shall overcome. Remember, if he's an angel, you would have heard that there is a lot of noise in Kenya. If he's an angel, I mean, where there is a lot of noise, an angel will not come. Angel Gabriel will not come. Yeah. So we shall overcome. So I'm looking forward to teaching you guys. But now remember, for this thing to become viable, we need to have more than 100 students signing up for this course. More than 100 students. Do you think I can get over 100 students signing up for this SPR? Because you know me, I normally teach the advanced level FM. All right. All right. So please ensure that you are bringing your friends from all over these colleges, because I know FM is a disaster and I would want to help you. I would want to help you. Yeah. Sarah has a question. I was forgetting Sarah. So Sarah, let me just mute here my recording. Yeah. So I believe you guys will be able to bring in your friends for you to ensure that Mwalimu gets over 100 students doing SPR, and then we shall be able to come up with a timetable. Our number for inquiries is 0719 525 000. 0719 525 000. Sarah wants me to consider this concept of that Mwalimu should introduce like a discount. Sarah, if you look at, for example, our sister great colleges outside here, they are charging up to 11. Some are charging up to 11,000 per one paper. So when I give you 3,800, and Sarah, given what I'll be doing, Sarah, trust you me, you will get value for your money. You will get value for your money. Trust you me, 100%. And again, Sarah, I've been nice. I'm a nice father. Why? Because I'm telling you that you can, in this case here, pay in 2 installments or even 3. Hata ukiweza kulipa 900, Hivyo. So long as usikue ninja mbaya, utakuwa white ninja. We don't want black ninjas. White ninja anajikokota kia anamaliza kulipa like that. So I believe, Sarah, we shall be able to work together. That's a very good plan. You can't get that kind of a plan anywhere. You can't get that kind of a plan anywhere. Trust you me. All right. So I've seen already one student has paid. Our pay bill is 62,42,839. Account number FM SPR. Don't fail to write SPR, because if you fail, then the system will pick you for the normal class and they will give you a balance of 1,000 to pay later. For those who have already paid 4,800, Bevelin, and you did financial management last semester and failed, then you will simply write to me. I gave you my number, a message, and then of course you must give me proof that you tried the paper last semester. You must give me proof that you tried the paper last semester, because this class is a special class for ninjas who are wounded. Ninjas who are wounded slightly. So ninjas who have some ideas. When I tell them, in this case here, throw this kick this way, I tried it for the first time. The number is 0721. The number is 0721 620 183. Yeah. And when I say wounded black belt ninjas, oh, we shall overcome. Yeah, it's wounded, yes, wounded. And you should not feel bad, because I'm telling you, it's only 8 days to our exam. We do this exam and we pass. We do this exam and we pass. Yeah, you should pay in the course of the day. I don't think this ninja took my number very well, 0721 620. You know, at times I speak very fast. Even my wife at times telling me, Mwalimu, you speak very fast. Mwalimu, you speak very fast. So I've typed it there, 0721 620 183. And now that marks the end of my class. Daniel has a question. Please, okay, Janet, you have my number there. You can write me a message. So Daniel has a question. Yes, Daniel, please go ahead and ask. This coming December, we are passing. Coming December, we are passing, hallelujah. Yeah, we are passing. And thank you very much for spreading the word RCM outside there like fire. Thank you so much. That is why we are willing to always do more for you. Thank you and bye.